Okay. Looking into the chapter 2 here, under that we have the first slide which says investment appraisal and corporate finance decision. Under this, firstly, we have the corporate finance. Corporate finance is basically an investment appraisal. So under that, we have the first topic, that is investment appraisal. So under corporate finance, investment appraisal is basically a tool that decides if we should spend money on the project or should we not spend money. Next is the financial managers only do three jobs, that is where to invest, where to get the money, and how much profit to give to the shareholders. These are the three jobs that a financial manager has to do: where to invest, where to get the money from, and how much profit to give to the shareholders. Next, we have shareholder wealth. Under shareholder wealth, the main goal is to maximize the shareholder, i.e., make the shareholder richer, increase the share price. Okay. Try to make the shareholders richer. Shareholder wealth maximization is the primary objective. Next, we have the long term success. Under long term success, we look into that good decisions today. Okay, under long term success, we are looking into that good decisions today will make the company grow and survive in the long term. Okay, good decisions today will make the company grow and survive in the long term. So these decisions shape the business growth and sustainability. Good decisions today make the company grow and survive in the long term. Good decisions today make the company grow and survive in the long term. That is long term success. And next is strategic importance. Okay, choosing the right project is the most important part of finance. Choosing the right project is the most important part of finance. Choosing the right project is the most important part of finance. That is strategic importance. That choosing the right project is the most important part of finance. So these are the five ideas. Corporate finance, we understood. It's about investment appraisal, which is a tool which helps us to decide whether to make a investment or not. Second, three decisions the financial manager has to take: where to invest, where to get the money, and how much profits to give to the shareholders. Under shareholder wealth, this is the primary objective, is the shareholder wealth maximization. Under long-term success, these decisions shape the business growth and sustainability. So, good decisions today will make the company grow and survive in the long term. Strategic importance, under this, investment appraisal is central to corporate finance. This basically means that choosing the right project is the most important part of finance. Choosing the right project is the most important part of finance, right? So, choosing the right project is the most important source of finance. So, choosing the right project is very important. Choosing the right project is very important. Okay. Next, we'll go into slide 2 here. What about slide 2? Everything around slide 2. So in the slide 2, if you see, the main heading that is given is the three key financial decisions. So we'll go into the three key financial decisions. That are the three key financial decisions. We have investment decision, financing decisions, dividend decision, the interconnection between the decisions and business growth. The firstly, under investment decision, decide which projects and assets should be undertaken. So it basically means that which projects should the company spend money on, which projects to pick. That comes under the investment decision. Under financing decision, we look into how do it basically says the choose between debt, equity, or a combination of both. Choose between debt, equity, or a combination of both. Here we look into how do we get the money. Okay, either we can get it from loan, either we get it from shareholders, either we can get it from both. That's what we look into financing decisions, that how do we get the money, loan, shareholders, or both. Loan, shareholders, or both, where do we get the money from. Under investment decision, where should we spend the money on. Okay, where should we spend the money? That is investment decision. Financing decision is how do we get the money. Investment decision is where should we spend the money. Financing decision is where do we get the money. Okay, investment is where should we spend the money, and financing decision is how do we get the money. Okay, next, coming to dividend decision, it said decides how much profit should be distributed to shareholders. It's basically how much profits to give to owners versus how much to keep in the business. So here we're deciding how much to give to the owners versus how much do we keep back in the business. Interconnection of the decisions, every financial decision affect the others. All three decisions are linked. Change one and the other changes too. Okay, change one and the other changes too. Under business growth, these decisions determine long-term financial performance. It's super simple that good choices here, right? If you make good choices now, the company will grow. If you make bad choices, the company will fail. Right? In these three decisions, if you're making good decisions, the company will grow. Here, if you're making the bad decisions, the company will fail. So it just comes down to good decisions versus bad decisions. What is the quality of decision that you're making? Okay. Next, we look into is how are the decisions interlinked? Okay. How are these decisions interlinked? Okay. Let's looking into how are the decisions interlinked. So looking into the interlink of the decisions. Firstly, investment decision and finance decision. Investment depends upon the availability of finance. Okay. Investment decision depends upon the availability of the sources of finance. Okay. What this means is that you can't pick projects unless you have money first. You can't pick projects unless you have money first. So investment and finance are connected that way. Next, we have finance and dividends. Under this, we have debt financing reduces the cash available for dividends. Debt financing reduces the cash available for dividends. It means that if you take a loan, you pay interest. Less money is left to give to shareholders. Okay. So if you have taken a loan, you have to pay interest. So you have lesser money to give to the shareholders. So this is how finance and dividend are connected. Next, we have investment and dividend decisions. Under investment and dividend decisions, it's given over here is that successful investments generate future dividend payments. Successful investments generate future dividend payments. What this means is that good projects will make profit, more dividends later. Good projects will make profit, and more dividends later. Good projects will make profit, more profit will give you more dividends later. Okay, good projects will make profit, and more profit will give you more dividends later. Good projects will make profit, and more profit will make more dividends later. Okay, so that is about the investment and dividends. Next, we have the funding choice. Under the funding choice, we have financing methods affect project risk and return. Financing methods affect the project risk and return. Financing method affects the project risk and return. Okay, so whichever financing method you use, it affects your project risk and it affects your project return. Okay, so what it means over here is that if you have high risk, there might be higher return. Okay, equity has low risk, so you will have a share in the profit. Choice matters. So again, it just comes down to high risk, high return. Okay, so if you look into the funding choice, it says financing method affects the project risk and return. So how are you funding your project? Are you using debt? Are you using equity? How are you funding your project? If you go for loan, right, loan has a certain amount of risk, right, for at least for the company perspective I'm talking, not from the investor perspective. From the company perspective, loan is high risk, so there's high return. Equity is low risk, again there's a lower return there, especially in case of the company's perspective where they are choosing which method to invest the project. So if the company using debt has a fixed payment, they have to make interest, whether you make profit, whether you don't make profit, doesn't matter, you have to still pay interest. That's why they say loan is higher risk from the company perspective. And again, if we talk from the company perspective, if I talk about equity is for the company lesser risk. Why? Because if someone invests money, if you don't make profit, you don't need to pay them anything. If you don't make profit, you don't need to pay them anything. So again, it depends how you are funding your project. Are you using equity or are you using debt? Next, we have integrated planning. Under integrated planning, it says financial decisions should be evaluated together. Basically, it means that don't decide investment, finance, and dividend separately. Think all of them together. Don't decide investment, finance, and dividend separately. Think all of the three together. Okay, so don't decide investment, finance, and dividend separately. Think all of them about all the three together. So this comes around how the three decisions are interlinked. Okay, are we clear with these three here, Shri? Were you able to catch up all the topics? Yeah, okay. We looked into the first one over here. In the first one, we looked into corporate finance, the three decisions, shareholder wealth, long-term success, and strategic importance. Okay. So these are the things we looked into, at least from the first slide. In the second slide, when we looked into the three decisions that are there. Along with that, we looked into the interconnected decisions and the business growth. This is what we looked into in the second slide. In the third slide, what we looked into was investment and finance. How are they interconnected? Finance and dividends, how are they interconnected? Investments and dividends, how are they interconnected? The funding choice we understood, and integrated planning, that all the decisions should be taken together. Okay, so these are the three topics that we've looked into as of now. Moving on now, the next one we look into is free cash flow, the foundation of investment appraisal. Now, what do we mean by free cash flow? So let's look into everything around free cash flow and how this is really important here. So when we look into the free cash flow, it's the foundation of investment appraisal. Okay, investment appraisal we saw under corporate finance. The first thing, it's a tool that helps us to decide whether to invest in a project or not. They say now free cash flow is the foundation of investment appraisal. To do investment appraisal, you need a foundation. That foundation is free cash flow. So let's look into free cash flow, which is the foundation of investment appraisal. Under that first one we have, under free cash flow, the first one is free cash flow represents cash available, okay, after business investments. So what is free cash flow? They say free cash flow represents the cash that is available after business investments. What is free cash flow? It represents the cash that is available after business investments. That is free cash flow. What does it mean? It's the money that is left after paying for all your business expenses. Okay, the money that is left after paying for all your business expenses and for purchasing all the business assets, whatever money is left after that, the real cash is called free cash flow. You've paid all the expenses, you bought all the assets. After that, whatever money is left, that is called as free cash flow. Okay, that is called as free cash flow. Next, we have cash based measure. Next, we have cash-based measure. Under that, the original is they say free cash flow focuses on cash rather than accounting profit. When we talk about free cash flow, the focus is on cash rather than accounting profit. So, what is the simplistic meaning of this? That profit can't lie, right? Profit can lie, cash doesn't. Your profits can lie, manipulated. Cash doesn't. So, free cash flow shows the actual money in hand. So, free cash flow it shows the actual money in hand. Free cash flow can never lie. Profits can lie, cash flows can never lie, right? So free cash flow is a cash based measure. Free cash flow is a cash based measure. What is free cash flow? It's a cash based measure. Okay, next we have business evaluation. Under business valuation, what are we looking into? Firstly, free cash flow can determine the company's value. You can use free cash flow to determine the company's value. You can use free cash flow to determine the company's value. Okay. So what does it mean? It means that we value a company based on how much cash it generates in the future. Free cash flow can determine the company value. It basically means that we value a company based on how much cash it can generate in the future. How do we value a company? Based on how much cash it can generate in the future. And that is how free cash flow is used in business valuation. Next, we have capital providers. Under capital providers, free cash flow is available to both debt and equity holders. Free cash flow is available to both debt and equity holders. Free cash flow is available to both debt and equity holders. Okay. And what does it means? That this cash can be used to pay loan interest or it can be used to pay dividends to shareholders. So this is the money that can be used either to pay the dividend, either to pay the debt. What it can be used either to pay the dividend, either to pay the debt. That is what free cash flow can be used for. And finally, investment analysis. What is investment analysis? Free cash flow forms the basis of project appraisal. It means that to check if a project is good, we use free cash flow. We consider the free cash flow that it will generate. To check if a project is doing good, we use the free cash flow it will generate. Okay. To check if a project is good, what do? We check the free cash flow it will generate. That is the meaning of investment appraisal. How is free cash flow used in investment analysis? Is that using the free cash flow will assess how good a project is and how much money it will generate in the future. Capital providers, whatever the free cash flow is, from that only we pay to the debt providers, from that only we pay to the equity shareholders from the free cash flow. Okay. Next, business valuation. What is business valuation? How do we use free cash flow in business valuation? We value a company based on how much cash it can generate in the future. We value a company based on how much cash it can generate in the future. That is how it's used in business valuation. Next, we have cash based measure. Under cash based measure, free cash flow focuses on cash rather than accounting profit. It means profits can lie, cash flow cannot lie. Okay. And what is free cash flow finally? It represents the cash that is available after business investments. Okay. The money left after paying for all the business expenses and your business investments or your cash asset investments. After that, whatever money is left, that is called as free cash flow. Okay. That is called as free cash flow. That is about this. Moving on now. Okay. Now we are seeing how free cash flow is used in investment appraisal. How is free cash flow used in investment appraisal? Okay. How is free cash flow used in investment appraisal? Okay. How is free cash flow used in investment appraisal? So looking into the slide 5 over here, how is free cash flow used in investment appraisal? Free cash flow is nothing but revenue minus cost minus investment. Okay, we have a formula here. What is free cash flow? It is revenue minus cost minus investment. What it means that free cash flow is nothing but money coming in minus money spent on running the business plus minus the money spent on running the business minus the money spent on new assets. From whatever money comes in, you subtract the money spent on running the business. From that, you subtract the money spent on new assets. Whatever is left is called as your free cash flow, right? Whatever money comes in minus the money spent on running the business minus the money spent on buying new assets. When you subtract, you will get your free cash flow. Next, we have FCFE. Right, FCFE shows the cash available to shareholders after debt cost. So free cash flow is of two types: FCFE and FCFF. FCFE tells you how much money you have that you can use to pay your equity shareholders. How much money you have to pay for your equity shareholders. Right? FCFE tells you how much money you have that you can use to pay your equity shareholders. And this is pretty much the money that is after paying the debt holders. So under FCFE, right? So first is FCFF, which is the high thing. Free cash flow is the concept of free cash flow. Under free cash flow, we have FCFF, right? It shows how much money you have that you can pay to your Debt available for debt costs. Okay, for debt cost. Okay, that is FCFF. Right? So how much money you have available using which you can pay for your debt. After you pay off your debt, whatever money is left, that is called as FCFE. Okay, that is called as FCFE. Okay, or let me put it like that in a more simplistic sense. FCF also is called as FCFF. So if you find it interchangeable in the exam, don't get confused. It's the same thing. Okay, it's how much money you have before you pay anybody. That is your free cash flow. And after you pay off your debt, then how much money you have left to pay for equity, that is called FCFE. So FCFF or FCF is used interchangeably. And after you pay off your FCFF, after you pay off your debt, how much money you have left for equity shareholders, that is called FCFE. Next, project evaluation. FCF is used in investment appraisal techniques, right? So it helps us to check if a project is good, right? It helps us to check if a project is good. So free cash flow helps us to check if a project is good. What we do is we discount the future cash flows. And once we discount the future cash flows, we get to know if the project is good or the project is not good. Okay. Next is company value. What about company value? Free cash flow supports the valuation and share price analysis. What does free cash flow do? It supports your valuation and share price analysis. Okay, what does that mean? That means is that higher future free cash flow means that company's worth is more, which means share price goes up. Higher the future free cash flow, it means company is worth more, it means share price goes up. Higher future free cash flow means that the company is worth more, it means that the share price goes up. Higher future free cash flow means that the company is worth more, means the share price goes up. Okay, what is higher future cash flow? It means that the company is worth more, which means that the share price goes up. Okay, it means that the company is worth more, which means that the share price goes up. So higher the free cash flow, the better. Okay, higher the free cash flow, the better. It gives a very good idea about the financial health of a company. Higher the free cash flow in the coming years, it means that if a company makes a free cash flow strong free cash flow every year, it can survive and it can grow in the long term. Right? It can survive and it can grow in the long term. If the company is making a lot of free cash flow, it can survive and grow in the long term. Okay, company value, higher the free cash flow, the future free cash flow from the company, higher the value of the company, and the share price goes up. Project evaluation, free cash flow help us to understand whether we should do a project or not. What do? We discount the free cash flows. What do? We discount the free cash flows. What is FCFE? FCFE basically tells that after paying all the debt holders, how much money we have left for the equity holders. After paying the debt holders, how much money we have for the equity shareholders. Now, okay. And then FCF or FCFF interchangeably, if this is the revenue minus all the expenses minus purchase of all the assets, whatever is left is our free cash flow. Okay, so this is pretty much giving us an understanding that how free cash flow is used in investment appraisal. Okay, so we have done with the 5 slides here, got a good understanding about this. Okay, so again, this was very generic here as an introduction to the topic. We just go through this once and you will have a good clarity on this. Okay, now looking into the next set of ideas here. Investment appraisal methods using free cash flows. Which are the methods? So here we are just getting an idea about all the methods, right? We are just getting an idea about all the methods. Then we look into each of the methods, but right now we are just getting an idea of all the methods. Okay, so let's quickly get an idea about all the methods here. So getting into an idea about all the methods here, firstly we have net present value, NPV, which is net present value. This is the first method. Second is discounted payback. Third is IRR and MIRR. Then duration and then decision techniques. So these are all the methods that we will study obviously in more detail in this particular chapter. But this just gives us a short summary of all the investment appraisal tools that we use, which use free cash flow. Okay, so we look into the first one here, NPV. NPV measures the shareholder value created by the projects. What does NPV do? It measures the shareholder value that is created by the projects. And what does that means? That NPV is basically today's value of all the future cash flows minus today's value of all the future cash outflows. When you subtract the two and whatever the difference is, if it's positive, it gives us a positive NPV, and if it is negative, it gives us a negative NPV. So you take the present value of all the future cash outflows, you take the present value of all the future inflows, and you bring it everything to time zero, and at time zero you subtract the inflow and the outflow, and if it's a positive number, that means if inflow is greater than outflow, that's good, and if the outflow is greater than inflow, not so good. Okay, so you should do the project only when the inflow is greater than the outflow. That is net present value. Next, we have discounted payback. Okay. Next, what we have is discounted payback. That is the second method here. Okay, that is the second method here. Discounted payback. What is discounted payback? It measures the recovery time using discounted cash flows. So it basically tells us how many years to get back our money after considering the time value of money. How many years will it take for us to get back our money? How many years will it take to get back our money after considering the time value of money? Okay, it tells us is how many years we will get back our money after considering the time value of money. After considering the time value of money, in how many years will we get our money back? Okay, in how many years we will get our money back? After considering the time value of money, in how many years will we get our money back? That is called as discounted payback. Next, we look into is IRR and MIRR. Again, this is something we'll study in detail, all the calculations. It calculates the project return using discounted rates. So basically, IRR is the percentage, the return of the project. MIR is the better version of IRR. Okay. So MIR is just a more superior version of IRR, right? It calculates the project return using discount rates, right? And MIR is a better version of IRR. Okay, MIRR is a better version of IRR. That all is MIRR, and we'll obviously see the calculation. Here we're just getting a brief understanding of everything. Next, what is duration? In duration is nothing but it measures the timing of the future cash flow. It checks how fast the cash comes in. It checks how fast the cash comes in. Earlier cash, less risky. It checks how fast the cash comes in. Earlier cash is less risky. It checks how fast the cash comes in. Earlier cash is less risky. Okay, it checks how fast the cash comes in. Earlier cash is less risky. Okay, it checks how fast the cash comes in. Earlier cash is less risky. Next we have is decision techniques. Different methods assess project viability. So we use multiple methods together to decide if a project is worth doing or not. Oftentimes you will see now we don't just use one method, we use multiple methods to decide whether it's worth doing a project or not. Okay, whether it's worth doing a project or not, we will use multiple methods. Just using a single method may or may not always give you the right answer. But if you use multiple methods on a broad scale, you will understand whether the project is worth doing or not. Now we look into the detail. Up until now, we just got a brief understanding of all the topics. The duration also we'll have Macaulay modified duration. We'll look into it from a calculation perspective. This has just given you a list. So this slide was just basically a list. Okay, now we look into the calculations and get a good understanding about each of the methods here and what exactly happens. So first we'll start with NPV. What happens in NPV? Okay, so this was just a introduction. First six slides were just introduction. Now we're getting into the main topics that we will be studying. Okay, so looking into slide 7 here, let's get a good understanding about this. So under slide 7, we have net present value, also called as NPV, which is the core concept. Okay, which is the core concept. So let's look into this. Okay, NPV is the core concept. Let's look into that. Firstly, positive NPV. Okay, accept projects that create shareholder value. What does positive NPV do? It accepts projects that create shareholder value. What does NPV do? It accepts the projects that create shareholder value. What does positive NPV say? That you have to accept the project that creates shareholder value. What does positive NPV say? Accept those projects that create shareholder value. Accept those projects that create shareholder value. That is positive NPV. Okay, accept those projects that create shareholder value. If your NPV is greater than zero, take the project. If your NPV is less than zero, don't take the project. Simple. It just makes shareholder richer. So if your NPV is greater than zero, then you will go for the project. That is positive NPV. If your NPV is less than zero, reject the project. Okay. And if you have multiple projects, choose the project with the highest NPV. Okay. If your NPV is greater than zero, accept the project. If your NPV is negative, less than zero, reject the project. Okay. If NPV is greater than the If your NPV is greater than zero, accept it. If NPV is less than zero, reject it. And if you have multiple projects with positive NPV, choose the highest NPV. That's it. So this is the simple core concept of NPV. Okay. Next is preferred method. NPV is considered as the most reliable investment appraisal method. The most reliable. Okay, because it directly measures value creation. Because it directly measures value creation. NPV directly measures value creation. Okay, what NPV does is directly measures value creation. That is why it is the most reliable investment appraisal technique. NPV is the most reliable investment appraisal technique. Why? Because it directly measures value creation. Because what it does is it directly measures value creation. What does NPV do? NPV directly measures value creation. Okay. So we understood what is positive and NPV. and negative NPV, highest NPV. Positive NPV accepts the projects that create shareholder value. Negative NPV rejects the project that reduce shareholder wealth. Highest NPV, it chooses the project with the greatest positive NPV. Preferred method, NPV is the most reliable appraisal investment appraisal technique. Okay. NPV is the most reliable investment appraisal technique. And wealth maximization, NPV directly measures value creation. What does NPV do? NPV directly measures the value creation. Okay. Wealth maximization, what does NPV do? NPV directly measures the value creation. That is about positive NPV, negative NPV, highest NPV. Okay. And preferred method, NPV is the most reliable investment appraisal technique. Wealth maximization, NPV directly measures value creation. Okay, so positive NPV, negative NPV, highest NPV, preferred method, and wealth maximization. Okay, so we got an understanding about positive, negative, highest, the preferred method, and the wealth maximization. So that is all about the NPV core concept. What is positive, what is negative, highest, preferred. It's the most preferred method because it directly measures the wealth creation, how much wealth is created. Okay. Now we'll look into next one is relevant costs. Okay, relevant costs. What to include, what not to include. Let's look into relevant costs now. So, what cost to include when you're using the NPV method? Which cash flow should you include and which cash flow would you not include? Okay. So here the focus is on what you have to include, and then we have a little idea on what to exclude as well, right? So this particular slide is important. Firstly, future cash flows. You have to only consider future cash flows, right? Only look at cash that will happen in the future because of the project, right? Only look into those cash flows will happen in the future because of the project. You have to only look into those cash flows that will happen in the future because of the project. Okay. Only look into those cash flows that will happen in the future because of the project. Very important. Okay. Next, incremental cash flows. Under incremental cash flows, include only additional cash flows caused by the project. Include only extra cash that comes in or goes out that happens due to this project. What is incremental cash flows? It means include only additional cash flows caused by the project. That means include only the extra cash in and out that happens due to this project. Only consider the cash that comes in or goes out that happens due to this project. Right? The cash that comes in or goes out that happens due to this project. Okay, that is incremental cash flows, cash that come in and go out, and that happens because of this project. Very important. Incremental cash flows. Next, ignore the sunk cost. Next, what you have to do, ignore. Past costs are irrelevant to the decision. Money already spent in the past, ignore it because you can't get it back. Money already spent in the past, ignore it because you can't get it back. Money that is already spent in the past, ignore it because you can't get it back. Very important. Money already spent in the past, what you have to do is ignore it. Why? Because you can't get it back. Next, exclude non-cash items. Next is what you will exclude non-cash item. Depreciation is not a cash flow, right? So no real cash has moved in case of non-cash items, so you don't include them. Example, depreciation. When there is no real cash movement, don't include them. In items when there is no real cash movement, don't include them. In items when there are no real cash movement, don't include them. Example, depreciation. When there is no real cash movement, don't include them. When there is no real cash movement, don't include them. Okay, when there is no real cash movement, don't include them. Example, depreciation. Next is relevant costs. Include only those costs that change because of the investments. Only include costs that will change if we do the project. Only include costs that will change if we do the project. Only include costs that will change if we do the project. Okay, what you have to do is only include those costs that will change if we do the project. Okay. Only include those costs that will change if we do the project. Only include those costs that will change if we do the project. Okay. Only include those costs that will change if we do the project. Only include those costs that will change if we do the project. Okay, that is relevant cost. That's it. Okay, so we only take future cash flows. We only take incremental cash flow that is happening because of the project. Then we ignore the sunk cost. Right, any cost that's already incurred in the past, we ignore that. We exclude any non-cash items, and then we keep relevant cost. Right, we include only costs that will change because of the investment. Right, we'll only include those costs that will change because of the investment. Very important. Okay, now discounted cash flow techniques, we'll get into this. But before that, we will see some sums here that we'll have from NPV V2 in the text. That will give us a good understanding about the topic. Okay. So note some here till here at present value. Now we got into time value. We got all the cash flows. We looked into each of them. Okay. And directly they've got into discounting. Then the impact of inflation. Okay. And then we have a sum of NPV after looking for the inflation impact. Not yet. Okay. Okay. So now let's look into next the discounted cash flow techniques. What is the framework really in a discounted cash flow technique? When we done slide 9. Okay, yeah. First let's look into slide 9 here. So firstly, we talk about time value of money. What is time value of money? It means that money today is worth more than money in the future. Money today is worth more than money in the future. Example, 100 rupees today is worth more than 100 rupees next year because you can invest it today and you can earn a return also because the value will go down in the future. So 100 rupees today is worth more than 100 rupees in the future. That is called your time value. Discounting is basically converts your future cash flows into present value. Yeah, converts future cash flows into present value. Right? It converts your future cash flows into present value. It brings your future money back to today's value. What it does is it brings your future money back to today's value. What it does, it brings your future money back to today's value. What it does, it brings your future money back to today's value. Okay, it brings your future money back to today's value. Okay, it brings your future money back to today's value. Okay, that is discounting. It brings your future money back to today's value. Brings your future money back to today's value. That is your discounting. Next, what is compounding? Compounding is basically converts your present cash flow into future cash flow. It takes today's money and see how much it will be in the future. It takes today money and see how much it will be in the future. It takes today's money and see how much it will be in the future. Right? It takes today's money and see how much it will be in the future. Next is wealth creation. Under wealth creation, discounted cash flow techniques improve investment decisions. If you use discounted cash flow techniques, you will see your investment decisions will improve. Right? Discounted cash flow helps you pick the projects that actually make shareholders richer. Right? Discounted cash flow techniques, if you use to do investment appraisal and make investment decisions, it will help you pick the projects that actually make shareholders a lot more richer. And finally, consistent valuation. Cash flows are compared at the same point in time. So what we have to do is we have to bring all the cash flows at the same time to compare them fairly. What happens is investment we will make today, inflows will come in the next 5 years. So what we have to do is we have to pull all the inflows from the next 5 years, bring it today, and then compare the inflow and outflow as of today. What we have to do is we have to compare the inflows and outflows as of today. What we have to do is that compare all the inflows and outflows as of today. So in case of time value of money, money today is worth more than money in the future. Discounting, it basically converts future cash flows into present value. Compounding, it converts present cash flows into future value. Wealth creation, discounted cash flow techniques improve your investment decisions. Okay, the discounted cash flow techniques, what it does, it improves your investment decisions. And finally, if you use the discounted cash flow techniques, you would notice that cash flows are compared at the same point in time. What is happening here is your cash flow is compared at the same point in time. Very important that all your cash flows are compared at the same point in time. Okay, what is happening is your cash flows are being compared at the same point in time. All your cash flows are compared at the same point in time. And you bring everything to time zero and then you compare it. Okay, looking into slide 10 here. Okay, so looking into slide 10 here, firstly, present value formula. So what does present value formula does? It calculates today's value of future cash flow. What it does, it calculates today's value of future cash flow. What does that mean? That you bring the future money back to today. What it means is you bring the future money back to today. What it means is you bring the future money back to today. What it means is you bring the future money back to today. You bring the future money back to today. That is present value formula. Annuity and perpetuity. Annuity and perpetuity, it values regular or perpetual cash flow streams. What does that does it? It values regular or perpetual cash flow streams. Annuity and perpetuity, what it does, it values regular or perpetual cash flow streams. Okay, it values all the regular or the perpetual cash flow streams. All the regular and perpetual cash flow streams anything that is regular, that every month, like EMI, you see it will be regular for a period of time. Perpetual, if you see, like for a very long period of time, like almost till infinity, it's a perpetual cash flow stream, so it values that. So whenever you want to value anything that is giving you a regular amount of cash flow for a very long time or forever, for the valuation of those kind of cash flow streams, we use annuity and perpetuity. So we use special formulas for every cash, for cash that is coming every year or forever. We use special formulas, right? In annuity and perpetuity, what we do is we use special formulas for cash that comes in every year or forever. We use special formulas for cash that comes in every year or forever. We use special formulas for cash that comes in every year or forever, right? There'll be some different kind of formulas. Inflation impact. So now what happens? Inflation reduces the purchasing power of money, right? For example, I always give a 8-year-old climbing 3 floors versus a 38-year-old climbing 3 floors. You will see the energy change will be very different. The amount of energy that both bodies will take, well, it's still 3 floors only, but both the bodies will take very different amount of energy to climb the 3 floors, and the effort that goes in all the 3 floors, climbing the 3 floors. It's the same 3 floors, but for an 8-year-old it will be a very different amount of energy spent, but for a 38-year-old it will be a very different kind of energy spent, right? So what inflation does is, inflation is something that reduces the purchasing power of money. It means that money loses value. 100 rupees today buys less tomorrow, right? What 100 rupees can buy today is not the same thing what 100 rupees may be able to buy in a week from now, in a month from now, in a year from now. That with time money is reducing the value. With time money is reducing value, right? Money is losing value. With time money is losing value. Now, okay, with time what is happening? Money is losing value. With time what is happening? Money is losing value. Yeah, what is happening? With time money is losing value. Okay, with time money is losing value. 100 rupees today buys less tomorrow. 100 rupees today buys less tomorrow. Inflation reduces the purchasing power of money. What inflation does, it reduces the purchasing power of money. Okay, what inflation does is that it reduces the purchasing power of money. Okay, inflation reduces the purchasing power of money. What buys money today is not the same money that 100 rupees. What 100 rupees can buy today is not the same what 100 rupees can buy tomorrow. Okay, what 100 rupees can buy today is not the same what 100 rupees can buy tomorrow because of inflation. Okay, and finally we have the Fisher formula. Fisher formula, basically it links nominal return, real return, and inflation. It connects real return, inflation to get the nominal rate. So when you take real rate and inflation together, you will get the nominal rate. So real rate and inflation together will give you the nominal rate. Real rate and inflation together will give you the nominal rate. Okay, real rate and inflation together will give you the nominal rate. And finally, we have accurate appraisal. Inflation adjusted calculations improve investment decisions. If there are inflation adjusted calculations, if in your calculations, if you adjust for inflation, you will make better project decisions. If in your calculation you adjust for inflation, you will make better project decisions. If in your calculation you adjust for inflations, you will make better project decisions. If in your calculation you include inflation as well, you will make a lot better project decisions. Your project decisions will be a lot better. Okay, we'll look into the formula over here as well. We will be solving it, but still looking into the formula here. So the Fisher's formula is the formula that we need to know. So seeking the Fisher's formula here. So as you revise, you can revise the Fisher's formula as well. Okay, so the Fisher's formula is here, and beyond that, we have the compounding and discounting formulas as well. Which we'll be using once we start with the calculation. There's a range of formulas here as well. Time value of money, it starts. So all the formulas are here. When you revise this, you can go through the formulas as well. And as we start the T by use, we will start applying these formulas. Okay, so 10 slides we have done.